This episode of From Angel to Exit is brought to you by the CEO's Right Hand. The CEO's Right Hand provides customized outsourced finance, accounting, and human resource services tailored to small and medium-sized businesses. Their services include fractional CFO, HR support, capital raising, and financial infrastructure development. They emphasize personalized engagements and expert support to drive growth and operational efficiencies. If you want to find out more, visit theceosrighthand.co. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today is Neil Schaffer. Neil is CEO at Carlton Advisors. We're going to get into a bunch of things. He's done several different transactions, some really interesting ones. We're going to have a chance to kind of talk through some of those learnings, kind of differences, experiences he's had, hopefully some insights for earlier stage companies that are looking to go through a transaction, exit at some point or close to a transaction, things they need to think about, be aware of, and maybe plan for a little bit. So
Awesome.
Excited for the conversation and to hear the story. So with all that, Neil, welcome to the program.
Bruce, thank you so much. Really happy to be here.
It's a pleasure to have you on. Before we get into the specific deals and kind of some of the transactions you've been involved with, love to get just a little personal backstory. I guess, how did you get into business? What was your professional background? Give us a little bit of that.
Yeah, sure. Happy to. Initially joined Price Waterhouse in their middle market practice in New York directly out of undergraduate school.
Okay.
Back in the day that there was such a thing as the Big Eight recruiting on campus. In my case, at the business school in Binghamton University.
Uh-huh.
PW for about 4 years. Amazing education. Yeah. And realized that I didn't want to grow up to be an audit partner, so I wound up leaving and moving along into a business career.
Yeah, good. And I know you've been involved in multiple transactions. Give us a little kind of overview of the world you've been in terms of M&A and kind of a little bit of the nature of things, and we can dig into them more specifically.
Sure. So ran a paper distributor when I left PW, was controller and then CFO of a paper distributor that was growing. It grew fivefold from about 50 to about $250 million of revenue, about 2/3 organic, about 1/3 as a result of acquisition.
Okay.
Left there after about 8 years and joined a startup food manufacturing and marketing company I told you in the preview. Yeah. We entered into 3 contracts to acquire 3 small brands, 3 small food manufacturers. Yeah. Those contracts were contingent upon financing, and the financing was contingent on actually taking the company public because it was part cash and part, if you will, public company stock that we were going to use for the acquisitions. We completed those transactions, had a little bit of money left over. It was a very small deal. I think we raised $4 or $5 million in the aggregate. We then identified a subsidiary of a large public company that was non-core to their business. We wanted to buy that company. The price was about $40 million. We had about $1 million in the bank.
Okay, so you're short 39.
So with the help of some amazing investment bankers, we raised another round of equity, a sizable round of secured debt, completed that transaction, and went from being a $7 million company barely making a profit to about a $50 million company making a very substantial profit. And that was the beginning of a series of acquisitions, some of which I was involved with, some of which was after I had left the company, but a series of acquisitions that evolved into the company being about $2 billion of revenue and about $2 billion of market cap.
Yeah.
So that was a very exciting moment in time.
Mm-hmm.
It burned me out.
I was going to say.
I lasted about 3.5, 4 years and I burned out.
Yeah.
And so a number of other adventures along the way, a couple of mostly mid-market companies,
Okay.
a couple of them that I started with co-founder. I've started 2 consulting practices.
Mm-hmm.
All of my businesses, my commercial businesses, have all been companies that I've either joined or acted as a co-founder.
Got it. So when it comes to these deals, I mean, I guess, do you consider yourself, kind of a strategic expert, a financial expert, or like what's your expertise, or what's your kind of view or perspective going into these M&A kind of opportunities in terms of like how you analyze them, like where you see the opportunities, how do you evaluate? Like, give me a sense of your kind of mindset around that.
So, yeah, the M&A transactions, other than with the food company, that was intent to be an acquisition roll-up kind of vehicle.
Yeah.
All of the other transactions have been strategic in nature. They've been oriented toward wanting to grow faster and knowing that geographic expansion or business line expansion or partnership with other, particularly technology and software providers, where we can figure out how to do rev shares and figure out mechanisms to be able to bring capabilities into my company, or bring my company into other geographic areas by very often making an acquisition of players that are already in that region the way we didn't want to plant the flag.
Yeah.
So they've tended to be strategic and or opportunistic in that way. And the exits have typically been, I guess there are a couple things that were at play. One of them is for companies that take on capital where previously, then in their first instance, where they've been running a company, they've been trying to go for product market fit, they've been funding a company internally. When you take outside capital is when I think entrepreneurs begin to consider exit.
Mm-hmm.
That's been the trigger for most of my businesses and most of my clients' businesses. You can bootstrap your way and think about long-term success of a company. As soon as you take outside capital, you then have to start thinking about how am I going to return that capital with a profit to to the people who entrusted me with their money.
Yeah.
I think the other thing with particularly companies that haven't taken equity or not taken significant equity, really looking at the market you're in and the business that you're in and determining sometimes whether you think you're at or nearing a peak of the business cycle, whether you're a company or an external, the macro business cycle, and looking at a market and saying, well, if we're approaching a peak and there's still some gas left in the tank and some growth left in the tank, and we think we're going to hit that peak in a year, you may want to, and you think the next cycle peak is going to be 5, 7, 10 years down the road. If you can see that far, you may decide that entering into that peak is the time to exit your company.
Yeah. I think it's a good point. And I think that's a lot of founders don't quite appreciate or fail to appreciate the significance of it is, the moment you're dealing with outside money, you're dealing with some kind of time frame for return of the money, and being able to have some kind of a plan, like tell some kind of story, have some kind of a plan when you're going to either raise capital or do a transaction of how that person, how that entity is going to get their money back is going to be part of their interest in the deal. Like I can have great financials, but if I don't see, don't see a window or an opportunity to do another transaction later that gets me my money back, it's going to be a hard deal to close. I mean, how do you, I guess, what's your approach on the sell side? Let's start there of kind of creating that story or kind of coming up with that model that says, hey, buyer, this is a great company, and this is how and when you could realize the return on your investment if you do this transaction.
So in terms of selling this, the narrative around selling equity?
Yeah.
I think it's a strategic narrative around the vision of the business's arc of progress, that you have a sense of where you are on the S-curve. Capital is required to enable you to realize that vision and be able to execute that plan. Absent capital, you either won't get there or you'll get there too slowly. You make the case that the market is ripe, you're ready, and the thing that's missing is fuel in the tank to be able to accelerate. You built the engine and it can go fast, but if you want to accelerate, you need some fuel.
Yeah.
Making the case that that if a certain amount of fuel will allow you to get to scale and be able to get the flywheel turning, if it's an early stage company,
Yeah.
to be able to make the case that once the flywheel is turning, then you've got it, then you're meeting different decisions. Do you want, do you want to be at stasis? Do you want the flywheel to turn at 25 miles an hour? Do you want it to go faster? Do you want it to move to a different part of the domain? What do you need to have happen? So having a vision of what you expect the company's trajectory to be per plan, I mean, to the extent that plans are met, which rarely happen. Man plans, God laughs. So
exactly.
but to have a point of view and have a really clear vision and be able to articulate that we're going to do this with capital, we're going to attain this result. If we do, or when we do, we will have an option before us. With the option, success brings options.
Yep.
So the option will be, is it worth exiting? Do you have a view toward, at a moment in time and maturity of the company, your financials and your operations look like X? Who in your marketplace wants X? Because I think most private companies maximize exit value by selling to strategic investors.
Yeah.
I think they maximize value, not just economic value for themselves and their investors, but I think there's more value, if you will, emotionally and psychically for the team. If they believe that they can become, continue to do what they're doing if they really believe in the mission and do it within the context of a larger organization that can support a bigger execution of that vision.
Yeah.
But a lot of companies shouldn't necessarily plan on unlimited life on their own.
Yeah.
In theory, perpetual corporations are a nice concept, but in reality, you may find yourself where, the greatest success is going to be, attaching yourself to a larger entity to give you more throw weight.
Mm-hmm. Yeah, I mean, I'm a big believer as, everything has natural cycles, right? Like every business is going to go through, some kind of process, some kind of journey, and, there'll be changes or transactions, at different points. And there's, the only constant is change kind of philosophy.
Sure.
I guess, how do you, or do you, and if so, how do you think about these kind of plans with more of, I guess, a financial exit versus a strategic exit? Meaning, financial being is, I'm basically looking for money. I've got a plan, like I've got some vision for the future, and I just need kind of cash, or I need powder to be able to get there. But it's basically it's pretty much contained in the business I have. I just need more fuel to push it, versus a strategic of saying, hey, we're a piece that, if put into the right puzzle, could really complete things. Do you think about those kind of strategies differently in terms of when you're taking a company to market?
I think they're two parts of the same story.
Okay.
Where I think you're dealing with the selling equity and in exchange for the fuel necessary to execute the next relatively short part of the journey, probably 2 or so years down the road, because normally the amount of capital you should raise is more than 1 and less than 3 years of fuel. Ideally, by the end of that second year, you should be positioned to either be cash flow break even or better and self-sustaining, or very clear about arriving at a place where you become more attractive for more capital at a higher valuation, because you've accomplished things that suggest that you deserve more capital to take it to whether this management team should take it to the next level. Yeah. The financials, in my opinion, the financials don't drive the company's business and strategy. They're a reflection of operations. I think you have to be very careful about not letting the tail wag the dog. Financials are downstream from every action that takes place in the business. It's a picture. Yeah. I think to me, the important part of financial analysis is that history does tend to go in a circle. And there are a lot of lessons learned, not only from your own financial experiences, but from those around you and others in your market and others outside of your market that you can learn from. But financial planning and analysis is really the important part, in my opinion, of working through and having really good quality financial information. I see a lot of companies, both big and small, that don't do a very good job of examining the treasure trove of their own data.
Yeah. Yeah. You mentioned earlier some equity, some debt plays. How do you look at the differences in terms of raising capital for a company on kind of the equity side or the debt side? And are there ways or situations that you lean more towards one or the other, or trade-offs from one to the other that you think
Sure.
about when it's like, hey, we need to scale, we need capital to scale. What should we be doing here? What's your kind of heuristics around this?
I think it starts with capital availability in the macro environment.
Okay.
When I started Carlton Advisors a year ago, I looked at the environment that we were in and decided that I generally was not going to focus on startups and early stage companies as my area of focus.
Mm-hmm.
Access to capital has been limited. Both debt and equity has become relatively expensive over the past couple of years. It isn't flowing. There's too much dry powder, and none. So you have the environment is such now that companies' innovation budget, their marketing budget, their R&D budget is actually inside their own business. So part of the pitch has been run a better business. You need your innovation budget, but it's got to be in growing your own revenue and earnings and cash flow. And by doing so, when the cash window opens, you will have the ability to be very attractive to investors because you've really had to sharpen your pencil. You've had to really run a better business.
Yeah.
If given a choice if I have a cash flowing business, if I have a business with earnings and cash flow, I would normally choose to raise debt capital rather than equity capital.
Yeah.
It's less expensive for one thing. I also think it requires the management team and the company to have more discipline because that money needs to be repaid on a regular basis, not some potential payday at the end of the day. So it really creates a different environment for the company.
Yeah. Yeah. What in terms of the transaction themselves, you gave your story of kind of the big one you did and being burned out after a couple of years. Like what are the things that you come to advise companies on as they're kind of thinking about a transaction? Things they need to do to kind of be prepared, either practically, emotionally, strategically, financially. Like what's kind of on your checklist of, don't think about doing a transaction until these things are kind of true or in place.
Yeah, a great question. I think I attack them separately, but the emotional questions is probably the first issue.
Okay.
What do you as the CEO, business owner, executive team, what do you all want as a result of this transaction? Do you want to leave? Do you want to stay? Do you want to be bigger? Do you want to be part of a bigger team? Do you want to play golf? What do you want to do? And have you really thought through what not working and losing your social, the social network that's represented by your team, by your customers, your vendors, your advisors? Like, have you thought your way all the way through, like not having those people in your life every single day? There's a lot of issues there.
Yeah. Well, then there's the flip side. It says, well, what's it going to be like to be with your husband or your wife? A lot more.
No, that's
changes.
That's exactly right. Your entire, your immediate true physical social network changes radically.
Yeah.
So some of it's just sensitizing people to that and really forcing them to ask themselves and answer the hard questions of what do they want to do with their time, with their life, with their money, if they actually, have money coming out of the business and they're able to, have liquidity from the cash that's been trapped inside of a private company. Now what? But setting that aside, let's say you get to a place where you have someone who will likely not experience seller's remorse.
Yeah, or sabotage deals.
Then you're dealing with what makes you attractive to a buyer. And what makes you attractive to a buyer is different than what makes you and your product attractive to a customer. It's a different environment.
Yeah, tell me more.
Because the buyer is fundamentally buying one thing. They're buying the probability of future cash flow. And that probability is a function of risk. They want to know that that cash flow is highly probable rather than risky. So doing that, getting positioned into that place, means not every decision has to run through the CEO. You have to have enough depth in the organization. Do you have a good team? Do you have the right people in the right seats? Do you have time to refresh that team? If what's your timing like around exiting your company? Have you really thought through the preparation? I think the other thing is, if you wish to leave, having a team in place is really important. If the leadership team intends to leave and they want to create an environment where the rest of the team, leadership as well as their associates and their staff, all have a role post-transaction, how do you ensure that?
Yeah, that's going to lead to, or potentially could lead to, a very different type of deal, or could lead to certain kinds of buyers.
Exactly right.
Yeah.
Going through the challenge of documenting playbooks, documenting SOPs, like going through you've got to create, essentially, I work with clients to create a knowledge base.
Yeah.
Bruce, you have a ton of information in your head. It can't stay in your head.
Well, they're not buying your head. They're buying the company.
In fact, if that's what you're selling, you won't command a premium price, and you will not be able to leave.
Yeah, exactly. Yeah,
and so now you go from,
and your retention is going to be bad.
So now you go from founder entrepreneur to having to say, "Mother, may I?" Because you don't own controlling interest in the equity any longer. You're not, but you're not in charge, and you're still there. So I think that realization tends to prompt a fair number of people to take the action they should take and to prepare their company for sale. If they're actually committed to sell their company, it's a bit of a wake-up call, but selling a company is a bit of an art form, and the preparation is, sort of the steps to prepare are pretty well understood in the market. If there is exit planning expertise in the market. It takes a few years.
Yeah, I mean, practically, timeframes. What do you typically like to see? In terms of having enough runway to do the prep work.
It's a 1,000-day journey. I think it's really 3 years.
Yeah. I had to do the math really quickly. Yeah.
So it's it sounds 3 years makes it sound a little
exactly. I was like 1,000 days. I was like, oh yeah, that's 3 years.
A little easier to tolerate, but it's actually one step after another for 1,000 days. The breaking it down, and by the way, breaking it down that way into sort of these 1 and 2 month sprints or 90-day sprints, where you're really going to pay attention to the 5 or 7 things that are really going to drive the most value in the company. And financial performance is only one of those things.
Yeah.
But if financial performance is important in moving your business up and to the right and showing consistent, improvement in financial metrics, that in and of itself may take 3 years, because buyers normally want to see 3 years in the can and a good forecast going forward.
Yeah.
So if
I'm curious if you see I kind of tease apart a difference between kind of valuation and buyability. I know it's subtle, right? It's kind of the things that I know that are going to drive a number versus things that are going to enable the actual transaction. Like, what do you look for, that actually helps the deal get done?
That's a great question. I think buyability is truly a function of both competitive advantage and company culture. I think those are the two things that most buyers will really look at, is like, can I replicate your business without buying you? And if I can't, then do you have the right kinds of people and the right, if you will, the right ethic that you will fit into my organization? Again, I'm thinking about a strategic buyer.
Yeah.
Financial buyers will tend to look at businesses a little bit differently. They'll tend to look more at the competitive advantage and the staying power and sustainability of the business, because they'll allow the culture to be what it is. If it's been successful, they're not going to be trying to wed that culture into a different or larger entity where there might be tension there.
Yeah. Well, and talking about that, I mean, I find that strategic sales are fascinating, because sometimes, Yeah, the financial sales, not that they're easy necessarily, but they're more straightforward in that you're kind of looking at the financials, you're doing your forecasts, you've got some kind of plan. You say, if I inject this capital, what do we do with it? What's the margin look like as we grow? Like it's somewhat contained in a
Correct.
strategic. I mean, I've been involved in a couple of cases where it's not even super clear why they're buying the company, right? It's only post transaction that they're like, oh, I see. Like you've got this other product you can sell into our market, or you want to take this and like leverage it into kind of all these other customers. Like how do you look, or when you're selling and you're looking at a strategic opportunity, how do you evaluate the buyer's view of value of you, which may not be super clear or may be kind of complicated, so that you can actually negotiate or have a good sense of like, where should we really land on this deal, and how do I not leave money on the table and
Sure.
Miss an opportunity to realize my value?
Yep. I think it starts with don't assume anything.
Okay.
And it really is, if you're dealing with a strategic buyer, you have a wonderful opportunity to build relationships and have the dialogue with them to gain some clarity about why they want what you do or what you own or what capabilities you have. Why is that a force multiplier for them? Why is it, it's got to be 1 + 1 has to equal more than 2 in their mind.
Yeah.
How much more than 2? Why does it equal more than 2? Tell me, what do you intend to do with my capabilities? How do we take my capabilities and add them to your capabilities to do something that you're not doing and I'm not doing today at all? What's your vision about your business and how do we fit? So if you get good and reasonably honest answers to those questions, you could then make a better case for value and valuation. If you have clarity, because if someone tells me that their intention is to use my capability to enhance their product, to be able to raise price, to be able to go to new market, to be able to, sell more things to existing customers, for argument's sake, where the cost of acquisition is near zero.
Yeah.
That's very, very powerful, because now I can model that. Now I have enough information that on my side I can just go back to into my Excel models and represent what my business plus their business should look like.
Yeah.
And then make a case for valuation of the of what I'm bringing to the table.
Yeah. I'm always I tend to pay attention to the questions that they're asking early in the process. And I'll oftentimes probe, on the question a little bit, because it's usually because sometimes they really don't want to tell you a whole lot because they're trying to keep their cards close to the chest. But there's often tells in the questions, the way they ask the questions, what kind of information they want to know, right? You start to get some insights on, oh, okay. They really are curious about these customers in this part of the market. Like, I wonder what's going on here. And you can kind of snip out some of that stuff. Because it is a little bit of a dance, right? There's always a little bit of
that's why I said, if you can get them to be reasonably honest. I mean, that's really the part of that is they're negotiating from the very beginning. Yeah. And they're going to be guarded in what they tell you.
Yeah. I'm curious what you've run into on the deal side, that things that have either, complicated deals, derailed deals, or, kind of hurt valuations, or, just made things more dramatic than they needed to be. Like what typically comes up, or what have you seen come up in deals that are somewhat avoidable?
So I think valuation and negotiating terms are always challenging. I think that they're two different things. I had a CEO a long while ago whose point of view was was really interesting to me. He said, "Your price, my terms."
Yeah.
And it was very clear about the terms are very often more important than the price. So negotiating deals and deal points is actually, a challenge on almost every deal. As a CEO or CFO representing the company in the sale, being on stage the whole time and being very sensitive to like everything you say can and will be used against you.
Yeah.
Every number that goes on a page is
Uh-huh.
carved in granite. So you have to be very, very circumspect about what you share and how committed you
Yeah.
are to the information, being very responsive to the deal and knowing that like you don't have a life during the time that the deal is in the, if you will, the final stretch.
Mm-hmm.
Can be very, very demanding for everybody. Needing to be diplomatic with bad lawyers,
Mm-hmm.
and dealing with just, drain people all around you who very often will work hard to, be impediments, even if they don't mean to be. It just
Mm-hmm.
seems like they do it almost, it feels like they're doing it on purpose.
Yeah, it's hard.
And I have had professional services providers show up at closing or surrounding closing when there's lots of money on the table and just throw down unexpected, ridiculous invoices and deal
Mm-hmm.
with the, I want to grab some money while it's on the table, and
Yeah.
we didn't necessarily agree to any of this. And they're
Yeah.
like, they're there and like, there's the potential for them to impede progress at the end as well. I've seen that happen once.
Yeah. I'm curious to kind of flip to the other side in terms of the acquiring side. I guess, how do you look at, you mentioned acquiring for growth, for geographic expansion. I mean, when you look at, expanding, growing a company through acquisition,
Mm-hmm.
what are the typical things that you're kind of looking to do with these expansions? Is it primarily financial? Is it strategic? Is it customer base? Is it geography? Like what are the factors that come up when you think about non-organic expansion?
Um, to me, it's strictly strategic.
Okay.
I think that usually it'll be an intention to have a goal or an outcome, whether it's being able to serve more customers in a different geography, be able to bring different capability, be able to have more pricing power, by enhancing capability that I have that I don't have today.
Mm-hmm.
Customers asking for things that I could sell, but I need to have capabilities that I don't quite have right now. So they're very often things that are it's really being driven by the market.
Okay.
And then, obviously downstream, there's, financial implications of that growth and of that expansion.
Mm-hmm.
So that it tends to be driven by the business plan.
Okay.
And if the business plan says our plan is to be a nationwide service provider or a nationwide product company, or be able to have, 50% market penetration
Mm-hmm.
in 5 states, but right now I'm only in, one small town.
Yeah.
How do you, if that's the plan, what do you need to do to get there?
How do you evaluate an individual opportunity, from a risk point of view, from a culture point of view? Because I think it's easy to look at a website and see their services and it's like, hey, look, we could bring that in. That would be a great complement to the other things we're doing. We see their client list, we could sell them. Like, there's a lot of, surface level synergies, but as you kind of dig under the covers, kind of really figuring out how viable or how complicated is deal going to be, and then how does it drive the transaction process or the offer, or kind of deciding whether or not to do the acquisition. Like, how do you get under the hood a little bit?
Well, I think most of the transactions that I've been involved with for acquisition-based growth
Mm-hmm.
have been either in my area of business or so closely aligned and adjacent to my area of business, the actual product and or service I'm delivering and or the geography. Even if it's a different geography, I will be very clear that I'm acquiring an extension of my company to be able to move into a different geography.
Yeah.
And so sometimes you're really valuing market penetration of that other entity, reputation, quality of team,
Mm-hmm.
net promoter score, things like how well regarded is this company. You'll know they're your competitors, and or they're adjacent in some way. It's interesting when I talk to clients about acquisition, and I'm not in their industry, because frequently I don't come from the industries
Yeah.
of the clients that I serve. Sometimes yes, often no. they should know who they want to buy and who should buy them. If they're, if they're really embedded in their business and they really know their business, their customers, their market, their product, they know who they admire. They're like, who do you want to buy and or sell to? And so very often in the conversation around who do you want to sell your company to, the place to start that conversation is, if you could, who would you buy? It's like having the brainstorming session around what would you like to do tomorrow and what how do you want to go and grow? Very often the best way to facilitate that is say, what are you doing today that you shouldn't do? What have you been doing yesterday that you shouldn't do tomorrow? And start peeling away the things that you're doing and like be able to brainstorm around what not to do. And after you get past that, turn the coin and be like, okay, what should we do?
Yeah. And I kind of want to cover this from both sides, but how do you create a market, or how do you create a situation where you're really going to get the best opportunity, either as you're selling? I run a lot of these founders who, they come to me and they like, hey, I just got this offer from this company and we're trying to evaluate it. We should take it or not. I'm like, okay, well, what other offers have you gotten? And then typically the answer is no. And I'm like, okay, well, what are we doing here? So how do you make sure that you're really looking at all the options, that you're really getting all the potential buyers to the table, that you're creating a reasonably competitive scenario so that you're getting the best options? Like, what does that process look like?
For purposes of selling your company?
Yeah.
I honestly believe that there are a couple things. One is I recommend that companies consistently and constantly be on the lookout for what they want to buy and what they would want in exchange for selling. That ideal state, and make it part of their strategic planning. Make it part of at least your quarterly planning process, not monthly necessarily, but it's like, make it an active and ongoing part of your day to think about, if I could, who would I buy? If I could, who would I sell to? And then work that into and work your financial models, because it'll force you to know what your comparables are. It'll force you to pay attention to what deals are getting done in your market, and talk to business brokers, talk to M&A guys, have regular, if you will, informal valuations done at least once a year. Just have investment bankers will show if you look like you're a viable client today or an exceptional company that could be a viable client in the future, they will be happy to engage and give you some insight and give you some sense of, back of the napkin, your business looks like it's worth 6 times EBITDA. And it looks like if you get it, by the way, if you get it from $7 million of revenue to 10, that multiple will go from 6 to 7 just because you're larger.
Yeah.
So if you make this part of your day, make it part of your daily plan, not daily, but periodic planning process. Don't just think about your own budgets and sales and what you're going to do. Look outside your company and maintain, clarity about what is happening in your market and what deals are being done, and understand those trends as well. Are valuations are they going up? Are they going down? If the norm is 6 and someone went off for a 9, find out why.
Yeah, exactly. There's a story there.
Do your best to try to get underneath what was that caused that thing to have a 40% better valuation.
Yeah. Yeah, my kind of philosophy is you want to have a plan for operating the business forever, but be ready to sell at any time, right? And at that discipline of, having, because I always say, like, a buyer is going to want to have a plan for the business, right? So you better have the plan for the business to be able to sell to the buyer. Now, they may want to change it, but if you don't have a plan for where the business is going to be in 3 to 5 years, like, a buyer is going to have to come up with one. It may not be the one. It may not be the good one, right? Like you want to be able to tell a story. But I think your point of being ready or being, thinking about this on a regular basis, quarterly, semi-annually, knowing, okay, what would it take? Like, if we got an offer, what offer would we have to have for us to be willing to sell? Where is the market going? What's been happening in the market?
Exactly.
And the other one, if we're peaking, right? If this market is peaking a little bit, we either need to be thinking about getting more aggressive on doing a transaction in the next year, 2 years, before we're on the other side, or we need to commit to being in this for the next 7 to 10, right? Because, if we're going to be going through a down cycle, the last thing you want to be doing is trying to sell at a down cycle, right? You want to be able to get through that and get to the next up.
Yeah, well, I also think, if you believe in your business and you actually think that being in it through that next down cycle and up cycle, and you think that that's really what, you love your business and you want to stay, then you should plan, if you have the capital or can raise the capital, plan to opportunistically buy your competitors during the down cycle. Some of them will be ready to sell. Some of them will get frustrated. Some of them will be like, oh dear, I missed the peak, but I still want out because I'm done.
Yeah.
So I think, making this part of your planning cycle and part of at least your quarterly planning cycle, you have to do it with a certain amount of rigor. It has to be something that you're not playing with it and sort of doing like wishful thinking. There's real investigation that needs to be done. You really need to keep your ear to the ground. And I think it'll help you. It helps with your business as well, because it forces you to think clearly about what's happening in your macro market and in the larger market.
Yeah.
Not just your own market, but the business market and the macro, if you will, the business cycle in general.
Yeah. Great insights, Neil. We're going to hit time here. I want to give you an opportunity. If people want to find out more about you, about the work that you do, what's the best way to get that information?
Neil at Carlton Advisors LLC.com or the website. Happy to respond to direct inquiries via email is probably the best way. The website is informative, but I really prefer dialogue to then getting the opportunity to learn what business owners have in mind, what their key problems are, and whether I might be able to be helpful.
Awesome. I'll make sure that the information is in the show notes so people can get that. Neil, thank you so much for taking the time today. It's been a pleasure.
My pleasure. I've enjoyed it a lot. Thanks.